My name is Andrew Stotson. I want to welcome you to the Valuation Masterclass Bootcamp final presentations by our graduating students. These are some of the best. We've got amazing students, whether they're presenting tonight or not presenting. But what we're going to see tonight is the final of our presentations related to the trucking industry. And it's an industry I didn't know that much about, but I'm learning as listening to the presentations and seeing what the students are raising. So I think without further ado, I'm going to get us on to the next one. So let me just bring in Charlie. How are you?
I'm all right, thank you. How are you?
I'm good. You relaxed and ready to go?
Yes, I am.
Yeah, I was asking you guys beforehand about the hours that you spent. You said you spent about 160 hours on the boot camp.
Yeah, that's correct.
and I think we're going to get a dose of what you learn in just a minute, huh? Yeah. Well, I think the audience is waiting. The world is waiting. And so I think it's time. Let me bring up your presentation. 1 second. All right. So I see your presentation now. And what I'm going to do is exit and let you take it over. Are you ready to go?
Yes, I am.
Okay. I'm going out.
All right, so I am presenting Traton, the undervalued gem with unmatched potential. I initiate coverage on Traton with a buy recommendation based on a target price of 70 euros, implying an upside of 131%. I derive my target price from a re-rating to a 15% discount of the sector, PB to ROE ratio, meaning a 2025 at 1.8 times the price to book. The primary reasons include Traton's expansion plans in China, economic recovery, and regulatory changes to ignite a surge in e-truck demand. However, there are also some risks, for example, failure to install sufficient charging infrastructure, stifled revenue growth in China, and e-trucks threatening competitive advantage. To provide some background, Traton is a German company which consists of 4 leading truck brands: MAN, Volkswagen Truck and Bus, Scania, and Navistar. Traton secures 21% of the global market share and operates 33 production and assembly sites worldwide. The majority of Traton's sales come from Europe and the US, mainly from trucks, with additional minor revenue streams from buses and financing solutions. I believe there is significant revenue growth potential for Traton for 3 main reasons. Firstly, economic recovery is expected to boost truck demand. Interest rates in Europe have already fallen by 0.25 percentage points and are expected to drop in the US. In 2023, Traton increased revenue by 16%, despite a 21% drop in incoming orders. This was due to backlogged orders and a price hike of approximately 5,000 euros per truck. However, the IMF reports Europe is expected to recover with a GDP growth forecast of 1.6% in 2025, which should restore business confidence and increase the demand for trucks. Secondly, Traton plans to expand in China to boost revenue and diversify production. Traton sold 320,000 units in 2023, and a plan to open a new plant in China with an annual capacity of 50,000 vehicles which is expected to start production in Q4 of 2025. This should enhance Traton's presence in Asia and diversify production to reduce vulnerability to supply-side shocks in the future. As well as increasing demand, Traton can benefit from lower taxes, reduced labor costs, and more efficient supply chains. To further boost margins, Traton's common-based engine features 80% standardized components for cost effectiveness. Traton aims to implement its common-based engine in MAN this year and Volkswagen in 2028. And I expect the gross profit margin to remain fairly steady at 19.8% due to other pressures on margins, and revenue to grow by about 7% in 2026 alone. Thirdly, EU regulatory changes in 2027 are expected to ignite a surge in e-truck demand. So far this year, Traton has received 2,000 e-truck orders, double the first half of last year, whilst MAN sold out in just 3 months, indicating there is a growing demand. E-trucks cost twice more than combustion engines, but EU regulatory changes on emissions are expected to boost sales in 2025 and 2026. To address high prices, Traton is introducing a pay-per-use model with a fixed rate per kilometer. Through a joint venture with Daimler and Volvo, they aim to set up 1,700 charging points in Europe by 2027. I project overall revenue growth to increase by 17% between 2024 and 2028, reaching nearly 55 billion euros. This forecast is 3 percentage points higher than the consensus estimates, which anticipate a 9% increase by 2026. Looking at the overall truck industry, major companies like Daimler, Traton, and Volvo dominate the market, generating about 62% of market share, with North America and Europe bringing 65% of unit sales. Global Market Insights claims the truck market is projected to grow at a 9% CAGR from 2023 to 2032. However, rising R&D costs to comply with new regulations, union-driven wage increases, and uncertainty regarding e-truck performance are putting pressure on the market. The director of specialty vehicles at J.D. Power has mentioned that with 2027 emissions regulations approaching, the industry expects substantial e-truck pre-buy activity leading up to the regulatory changes, while some companies such as Volvo are already seeing signs of it. Economic recovery and a booming e-commerce industry are driving demand for heavy-duty trucks. And furthermore, demand in construction, mining, and logistics should also boost the truck market. Whilst the short term seems promising for all, there are long-term challenges which lie ahead for Europe's trucks. In Europe, persistent challenges including low bargaining power against suppliers and consumers, high raw material costs squeezing profit margins, and ongoing union-driven wage rises are expected to squeeze margins further. However, supply chain disruptions are expected to decrease, allowing companies to meet the surge in demand. In the long term, Europe risks losing their competitive advantage and some of their market share to Asia, which shifts to e-trucks due to lower performance. I believe these consequences are unlikely before 2027, giving European companies time to enhance their efficiency and revenue streams. So looking at Traton's quarterly data, in the first quarter of 2024, Traton experienced a year-on-year revenue increase of 5.5% and a 12.8% year-on-year increase in gross profit margin, and a substantial year-on-year increase in net profit margin of 35.5%. Traton reported a recurring EPS of 1.6 euros, which was up by 23.5% year-on-year and 41.6% Q-on-Q. The consensus estimates for the next 3 years are positive. Around 56% of analysts hold a neutral view on Traton, while 44% recommend buying. The overall consensus recommendation is 2.3, indicating a rating between hold and buy. The mean target price is only 7 euros higher than the current price, supporting the overall consensus recommendation. Consensus predicts revenue growth will drop sharply from over 16% to negative 0.6% in 2024, followed by a recovery of 4% and then 5%. The gross profit margin is expected to increase from 20% to 23%, and the net margin to rise from 5 to 6.5% in 2026. So focusing on the revenue breakdown, Traton's remarkable growth in the past 2 years is driven mainly by backlogged orders from the pandemic and a 10,000 euro price increase across both years. The group's operations, powered by 4 leading truck companies, generates 97% of total revenue, while financial services contributes to the remaining 3%. Breaking down the revenue, 55% comes from trucks and 11% from buses and vans. Vehicle services add 19%, and the other sources make up the final 15%. MAN and Scania dominate with around 32% of incoming orders each, and Europe generates over half of Traton's total revenue, with Brazil and the US being the most significant markets outside of Europe. Overall, Traton ranks in the lowest 20% among 230 non-financial companies in Germany, appearing very unattractive based on fundamentals, valuation, momentum, and risk. In fundamentals, Traton is ranked neutral due to a shrinking operating profit margin and below average ROE, but this is offset by strong asset turnover. In valuation, Traton's very unattractive despite these metrics suggesting it is undervalued. Traton's momentum is moderately unattractive, as revenue growth has softened in the past 12 months. And in terms of risk, Traton is ranked among the riskiest companies in Germany due to being net debt and increasing market volatility. Profitable growth ranked in the bottom 20% in 2020, however, the rank constantly improved each year to 5 in the past 12 months. Profitability improved annually from 9 in 2020 to 5 in the last 12 months, which has slightly held back profitable growth. However, growth surged from 9 to 1 and then has fluctuated between 2 and 3 since. Asset efficiency steadily increased from 8 to 6 between 2020 and 2023, and expense control has also shown a steady improvement from 8 to 5. Revenue growth has been volatile, rising from 8 in 2020 to 2, but falling to 6 in the last 12 months. Expense direction has improved from 9 in 2020 to 3 over the past 12 months, which has lifted the growth ranking. So moving on to Traton's financial statements, I believe revenue will grow very slowly in 2024 and 2025. However, larger increases in growth should be expected after that. I expect Traton's overall assets to increase as the company has strong expansion plans and requires more long-term debt to fund their plans. I expect an increase in cash flow from higher net income and debt, but also more cash to be spent on capital expenditure. And in terms of the ratios, the current ratio should marginally improve to 1.1, although this still puts the company at moderate risk. And I believe the inventory conversion days should increase due to a higher supply, not matched by a strong increase in demand. And EBIT margins should reduce while switching to e-trucks. I forecasted the effective tax rate to increase to 30%, as Traton has just under 1 billion euros in tax payables, of which 300 million are short-term. And here is the free cash flow data, which shows similar trends based on my stories and historic data. Traton trades at a discounted 2025 of 0.7 times PB ratio relative to its sector, domestically and globally. I expect Traton's ROE to be around 14.5% in 2025, which is slightly lower than the overall German sector ROE average. The industrial sector in Germany trades at a 2025 PB to ROE ratio of 0.13 times, and Traton trades at a more attractive 2025 PB to ROE of 0.05. Traton has traded at a significant discount to the industrial sector in the past, based on PB. In 2023, that discount was 71%. I don't see any reason for Traton to trade at such a big discount to the sector. Since it has traded at a discount in the past, I assume a 15% discount to the sector's 2025 PB to ROE. This re-rating implies a PB of 1.87 times, which is still higher than the company's long-term average trailing PB. Given a re-rating to a PB of 1.87 times in 2025, my target price for Traton is 70 euros. On the forward 2024 PE multiple, Traton trades at a discount compared to the industrial sector in Germany, Asia excluding Japan, and the world, so Traton looks very cheap on a PE basis. I expect its EPS growth to be negative in 2024 due to a weak year-on-year revenue growth, and this is due to lower backlog and fewer incoming orders. However, in 2025, a higher revenue should increase EPS growth. I assumed a risk-free rate of 2.5% and a market equity premium for Germany's market of 8%. Traton has been a high beta stock, so I assume a beta of 1.25 times, which is slightly lower than the previous averages. I forecast a capital structure with around 37% debt to total capital. This results in a WACC and a discount rate of 8.6%, and I used a fairly low terminal growth rate of 1%. In my base case scenario, I anticipate sales growth of 3.2% until 2028, leading to a value of 137 euros per share. Whilst there are strong growth prospects for Traton, the risks include, firstly, failure to install sufficient charging infrastructure could delay demand surges for e-trucks, resulting in longer periods of low momentum growth. Secondly, stifled revenue growth in China due to local competition may hinder Traton's growth in Asia. The presence of strong local competitors might limit Traton's market share and potential to expand. Geopolitical uncertainty and potential trade barriers could increase costs and reduce profit margins. And thirdly, switching to e-trucks threatens competitive advantage in high-quality and high-performance trucks due to a potential battery weight, cost, and range issues that could lead to higher competition, especially from Chinese companies specializing in EVs. So to summarize, while Traton currently seems to be a high risky investment due to increasing competition and high debt levels, their plans to expand and diversify should reduce risk and grow the company. The company's commitment to cost reduction and efficient delivery has already yielded strong returns, and with their e-trucks currently outperforming competitors, the future looks promising. Considering these factors, I believe Traton presents a compelling investment opportunity. Thank you.
All right, well done. And that's not an easy company, as we've done some work on this and gone through it. There's a lot of questions coming up in the chat, and I've got some stuff we'll go through. So let's go back to the valuation page, just one or two up from here. One of the things,
Yeah.
what was your dividend payout ratio that you're assuming?
Around 30%. 30%.
So at a 30% dividend payout ratio, you've got a value of about 22%, 22 euros. And that's compared to the price at, let's say, 30. So that's interesting that, you know, if that dividend payout ratio went up to 50, you're getting pretty close to the price in the market. So I thought that was kind of interesting. It's also worth highlighting that, you know, we've got some, you know, pretty extreme situation here from a free cash flow perspective. So I'd like to go to multiples for a second. So let's go back. Let's go down. Yeah. Okay. So the fact is, this company's trading on less than book value. In other words, the market's not even valuing its fixed assets, the existing assets, the whole existing business. They're putting a 20% discount on this business, despite the fact that the business is getting a 15% ROE. So we can say that the market is really negative on this company. What are some of your thoughts about, you know, where is that coming from, number one? And normally it comes because performance is bad. Now, if we do look back, if you go back to your, go up to your ratio slide, and we look at, go down one more. We look at the net margin. It was at 1.5, then 2.8, then 5.2. So, you know, we can argue that it was very low in the past, but I'm just curious, what are your thoughts about why the market's putting such a discount on this company?
So I think one of the main reasons when I was searching online, I found that a main concern was the amount of debt they had. Their debt is around 65 to 70%, which is massive. And this year and next year, the revenue has slowed quite a lot. And even in previous years, even though their revenue has increased, there have been signs of their incoming orders decreasing each year. So I think this has been it's kind of put many investors off because I think one of the main reason is because like incoming orders are going down. So some people believe that this may have an impact on the company in the future. However, I think because they're expanding so much and because they're trying to diversify and everything, and they're expanding into the e-truck market, which they're currently doing really well in, I think this is not the case, and we shouldn't use the incoming orders previously to kind of judge what the orders will be in the future.
And here you show on this page that you're forecasting 0.5, 1.5, and 7 for revenue. So it's not like you're being overly optimistic.
Yeah.
Okay. So yeah, we got this question about debt. Let me go up one slide and let's look at the net debt to equity. Okay. So net debt to equity is 1.1, 1.3, 1.2. I wouldn't say it's out of control. You know, it's a little bit high, but it's not necessarily out of control from my perspective. Let's go to the world-class benchmarking scorecard. This is one thing I like about this company is if you look at the scorecard, profitable growth was 9, meaning it was worst in the world or worst amongst this cohort of 1,440 in large industrial companies. So it got hit really hard in COVID. It didn't have a bounce back. As we can see, it only went from 9 to 8. But then it went to 7. And then it went to 5. And now it's at kind of average. If we look at profitability, what's really cool is it went from 9 in 2020, 8, 7, 6, 5. Now, this is a potential company that you could make some real money in if it could go from 5 to 4 to 3 to 2 to 1. But what is the likelihood that it's going to have, you know, that kind of improvement? Or does it sit at about 5?
No, I think there will be improvement in the future. So Traton, as I mentioned, the common-based engine, they're planning to implement that in 2 of their companies, which would significantly reduce costs and increase profitability. And also, they are trying to combine departments from each of the four companies. So instead of doing the same thing 4 times, you reduce costs significantly by just doing it once overall for all the companies. And this is one of the main reasons why profitability has increased. And they're still continuing to work on this. So I think it will increase in the future.
And can you go to the industry page? Yash had a question here. He said, one of your major stories is from China. And when I see your revenue breakdown is not even shown as one of the major revenue drivers. But I thought that's interesting about the company. We can see on this particular slide that it really doesn't have a presence in Asia. The biggest one in Asia is Daimler. PACCAR in America doesn't have exposure to Asia. Maybe you can just talk about the revenue, the distribution of their, and could it be that because they have a high exposure to Europe and South America, that's what's causing the multiple to be so low?
I think it potentially could be one reason, and hence I think expanding into China would be a really good investment strategy because it would also help them to increase their revenue, and potentially I think that would make them less undervalued in the future because they'd be able to diversify. It makes them less prone to shocks in the future, and they obviously bring in more revenue, and they can from that they'd be able to pay more of their debt. So I think it would also make it a little bit less risky. And just to answer Yash's question, I think he mentioned why do I think it's such a significant story? I think it's a significant story because it's not a strong market yet because they don't have any production sites there and they haven't focused on it yet. However, by expanding to a new location, they are likely to receive more orders, and not just from China, but also from a lot of Asia too. And also, this doesn't just help from a demand perspective, but also from a production perspective, because it gives them the opportunity to lower costs, which I think is significant to boosting their profitability.
Okay. And another question is about the increasing emissions regulation, particularly in Europe. How do you see pre-buying before 2027? Think Germany is imposing an increasing toll on diesel trucks?
Okay, so I think with the upcoming regulations, I think this is going to have a significant impact on the boost of e-trucks. And I don't think it's going to be it's not going to be 30% or 40% of the company's revenue, but I think it will be significant enough to boost their revenue to the 7% I stated. And in terms of risks of them backing out or pushing it to a later date, I think that shouldn't be too much of an issue because by the time they announce that we're going to shift the regulation to a different year, the sales would have already come in expecting that regulation to take place in 2027.
So let's just talk about where you see the breakdown of EV versus non-EV in the next, I don't know, 3 years or whatever whatever number you're hooked on.
Mm-hmm. So I think at the moment they're currently on 2,000 unit sales of EV trucks. And this is obviously doubled from last year. But one of the main reasons is because they're not able to supply enough. It's not a demand issue. So I think this could easily reach around 10,000, 12,000 orders per year in 2026.
Okay, so let me ask you, I'm going to ask you some final question about this because we've had a good discussion about the different truck companies. And I have a general rule, and that is in my investing is stay away from government when government starts to mandate and control and talk about, the things that they want. I always get really nervous because I think government officials become overly optimistic. And I'm just curious, how is it even possible that they're going to hit these types of targets that the European Union is setting? And could it be that people are just saying, if this company has to hit these targets, it's going to crush their business because, and that's the first part. But the second, I just want to highlight what you just said is that there's demand. Well, let's be realistic. If there's demand rising in EV, I suspect that demand is falling in diesel and other areas. It's not like there's some magic demand that's coming because government made a law and a rule. And so I'm just curious, what is the realisticness of the transition to EV in Europe and the impact on the company?
Okay, so to answer the first question in terms of governments just kind of throwing all these regulations and rules but not always implementing them, they have already implemented one this year in 2024 in May, where they've made it's like CO2 emissions accounting, it's become more compulsory rather than just something you can do. And they've put stricter regulations on what you need to include and how that needs to be done. So I think they are definitely moving forward with it. Like gone are the
And
times when
so,
they can.
and of course, that's going to increase the costs significantly. If
Of
they have
course,
their
yeah.
way, they want to put a real tax on carbon emission, right?
Yeah,
Okay.
exactly. And then, sorry, could you just repeat the second question?
So the second one is, where do you think the EV is going to really be? Yeah, the government's making big targets, but 3 years from now, these truck companies are run by pragmatic businessmen and women who have to be very careful to not get caught out, in a situation. I'm just curious, like, what is their target, in 3 years or so, of what they think their EV vehicles are going to be as a percent of total vehicles?
Sure. So they claimed that their target would, the EVs would be around 30% of their sales revenue, which I think is a little bit unrealistic. I don't think it will be that high, but I still think it will increase, partly due to, irrespective of whether the regulation gets implemented in 2027, the pre-buy activity is still going to happen because people expect e-trucks to they expect the regulations to come in 2027. But also in terms of like pricing, yes, it's going to be a lot more expensive. But I think companies do have that opportunity to pass on some of the price onto their consumers. And Traton in particular is trying to do this in a slightly more sensible way by changing their pricing model, by making it a fixed charge per kilometer. So it's easier for their clients to jump into, as well as other things they're working on to make the transformation slightly easier for them.
Mm. Yeah, I mean, it's interesting. Pricing going up usually means demand falls. Margin going down usually means profits fall.
Yeah.
And pricing going up means pushing the price onto the consumer. And the more the European bureaucrats push cost increases onto consumers, the more likely it is that they won't have demand, and therefore there's less trucking and all of that. It's interesting to see. 3 years from now, I want to, meet again and talk about that. So
Absolutely. But
interesting.
yeah. Oh, sorry.
Go ahead.
I was going to say, I do think that in terms of profitability, because they are because like I think they will be able to increase their sales. Obviously, the government's not really giving them much choice. And from again what I've read, the government seems really imposed on like trying to make sure this regulation comes about in 2027, if not maximum by 2028. And I think the fact that convinced me is that they're already starting to implement these things, which makes it seem like it's not something that's going to be really far-fetched in the future. It is something they're already currently working on.
So would you put your money down on this?
If I had money, then yes, I would.
All right. How does it feel to graduate from the Valuation Masterclass Bootcamp?
It feels amazing. I've loved it so much. I don't think I've gone a day in the boot camp without waking up and being like excited to kind of work on something or like start researching. I've really enjoyed it. Really, really enjoyed it.
That's exciting. That's really what my goal has been. And it's hard to get to this point. I would say I underperformed in my first five cohorts coming in, but now we've definitely got it going well. What was the transformation that you went through? Like, what can you do now that you couldn't do when you came in?
I think I've really learned how to research things properly. Like before, initially, like in the first week as well, when you said start researching Traton, and I just kind of started blankly looking at the like report, and I didn't really know what to look for. I was just kind of reading numbers and like trying to make some logic, and it wasn't really working. But over the time, I've kind of learned like when I want to look for something, how to search for it specifically and where to go into the financial report to look for these things. So I think that's really helped me. And also coming from a non-finance background, I think honestly the whole thing was a really big transformation. Like I've gone from knowing absolutely nothing to coming up with an equity research report.
What was your background? Remind us again.
I major in statistics. I'm a first year university student.
Okay, so first year university, don't have any finance or accounting background. Statistics, it's a good subject, but it doesn't necessarily help you in what we're doing here. So what advice would you give for someone that looks at the Valuation Masterclass Bootcamp and says, I didn't study finance, I didn't study accounting, I'm scared, I'm potentially overwhelmed? What would you say to them?
I would say just put in the hours. You've explained everything really clearly from a very basic level to a very advanced level. So put in those long hours, especially initially, where you cover all the basic finance things, which most other people would know, which I didn't know. And I think I did that. I had time to do that as well, and I really put in these hours. If I didn't understand something, I asked a lot of questions to you and Momin. And yeah, that would be my one advice: just putting the hours in. Wherever you don't understand something, be happy to put in more time to research it further.
Yeah, well, it's been great, and this group's been great, and your questions and contribution has been fantastic. So congratulations on that. And now it's time to relax a little bit.
Thank you.
Yep. Okay. We'll see you soon.
Bye.
Yep. Bye. Wow. That was great. Fantastic presentation and discussion. You know, that's a challenging company. There's a lot of upside there. The company is trading at a very low PE and price to book. And the discount valuation is a little bit tricky, although you could see the dividend valuation was actually getting close to the current price. If dividend payout ratio went up, then you'd be basically with a 50% dividend payout ratio, you'd be valuing the dividends at the price of the stock in the market. So that's interesting. And yeah, 3 companies. We had Volvo, we had Daimler, and then we had Traton, and all great presentations. So if you want to build a competitive advantage in company valuation, and like Chavi, you didn't have a background in finance as an example, come join the Valuation Masterclass Bootcamp. I've tried to design the course in such a way that we start from, you know, basics, and we move fast. You know, you gotta devote the time, but I've definitely built it from basics and ground up. And by the way, there's a 7-day money back guarantee. So you can just take 7 days. If it works, continue. If it doesn't, ask for your money back. Anyways, my name is Andrew Stotts, and I hope to see you in the Valuation Masterclass Bootcamp.